Hey, it is 12 noon on Wednesday, which means it's time for this week's episode of Ask the Instructor. I'm John Kurtzman. The show is brought to you by the Tampa School of Real Estate. And what we do every Wednesday at 12 noon Eastern Time is come to you live to help you understand the technical side of the real estate industry. And today we're talking about something that A, could show up on your real estate exams, B, is very important to understand if you're a real estate investor, or C, is important to understand if you're practicing real estate and you want to work with investors. If you want to be able to earn commissions from investors, you have to be able to show value. Show them the value it is that they're looking for, and that a lot comes down to cap rate. Now, cap rate is just a small part of the income capitalization approach. The income capitalization approach is something that you learn about in the pre-licensing course, but it's something that you'll see again and again and again when you're dealing with investment real estate. So we've got a great show for you guys today. I'm John Kurtzman. The show is brought to you by the Tampa School of Real Estate, and you're watching Ask the Instructor.
You are watching
Ask the Instructor every Wednesday at 12 noon Eastern Time. I'm John Kurtzman, or you're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Kurtzman. This show is brought to you by the Tampa School of Real Estate. We do this every Wednesday at 12 noon Eastern Time for our current students, for our previous students, as well as our future students, to help you understand the technical side of the real estate industry. And what we're talking about today is called cap rate. So this term cap rate, it's short for capitalization. Can't spell this morning. So it's short for capitalization rate. And what we're figuring out with this basically is how we're able to capitalize on the money it is that we've invested into some sort of income producing property. Now, like I said, this is important to know, not just for your real estate exams, but also if you're an investor or you plan on assisting investors, you absolutely want to understand cap rate as well as the entire income capitalization approach to coming up with value. And that's what that capitalization is. It's right in the name of the income capitalization approach. And essentially what we're doing with the cap rate is it tells us basically our return on investment after 1 year. Well, that's what we're figuring is what our income references to our cash investment. Now, you could still use cap rate when you're dealing with financed property, but what you're assuming is that cap rate is based on a totally cash deal. And it's a universal number that you'll hear investors talk about all the time whenever they talk about income producing real estate is the cap rate, because it's a very universal number that helps you understand your return, what this income is, this return is on the cash investment, on the total price of the property. So let's start off by doing what's called the Irv Triangle or the Irv Triangle. And then we're going to build on this a little bit more in depth to get a better understanding of what income is, because you need to be dealing with the right kind of income when you're dealing with capitalization rates. So let's start off with the Irv Triangle. So the Irv Triangle or the Irv Triangle, I-R-V, Irv, I-R-V, or Irv. This triangle is super effective for helping you remember three distinctly different formulas. And let's say that formula we're looking for is our cap rate. Now, the cap rate, this is our return on our investment. This is how much our income equates to over the first year based on the value of the property. So in order to use this Irv triangle, what you do is you circle the number it is that we're looking for. So we're looking for the rate. This is income, this is value, and this is rate. That's what these stand for: income, rate, and value. So we circle what we're looking for, and what's left over is our formula, I over V. So our rate is the income divided by the value. That's our formula, and it's helpful when you remember this IRV triangle because it'll make it that easy for remembering what the formula is. And the more it is that you work with this, you won't necessarily need to remember the IRV triangle so much. The more you practice this, you'll just start remembering this formula rather than having to remember the triangle. But when you're first trying to grasp around this, this is going to be a little bit of a crutch for you to help you make sure, whether this is on the exam or your first couple investment deals, that you're punching in the right numbers that you need to be working with. But there's two other formulas it is that we would be working with this IRV triangle, this Irv Triangle. So this one is going to tell us our capitalization rates. We will work through a couple examples with some numbers here to figure out what some rates are on some different types of property. But let's say we're not looking for the rate. We're trying to determine the value of the property. Also, a very important calculation. Really, all three of these numbers are very important when you're trying to understand an investment property. And this is whether you're looking to purchase the property for yourself to rent out, or you're helping somebody rent it out, or look, even if you're a flipper, even if you're a house flipper, unless you're selling to residential consumers that are looking to live in the property, if you're planning on selling to other investors, they're not just going to keep flipping and flipping and flipping and flipping and flipping it until somebody ends up keeping the property. That may happen, but eventually you're going to get to a person, usually after that first flip, where it goes to somebody who's looking to buy the property and hold it for rental income. So even if you're a flipper, you do want to understand this formula here to understand that rate of return that the investors are going to be looking for. So when we're trying to find value now, we circle what we're looking for in this IRV triangle. We're looking for value, and what we're left with is income over rate. So our formula for value is the income divided by the rate. So income over rate gives us the value of the property. Get a new blue marker. And now finally we've got income. That's our third formula here. So in order to find income, we circle what we're looking for, and then what we're left with would be rate times value. Now, you might want to draw in a little multiplication sign here to help you remember that. Or if you kind of remember with algebra, when you'd put two variables next to each other, R and V being different variables, you'd put them next to each other. It's like you have parentheses around them, and that means you're multiplying them together. So that's what's going on with the R and V here. But if you don't like algebra, I understand. Just remember to put that little little multiplication symbol in there, and you've got your formula. So our formula for income is rate times value. Now, really, you only need to use this triangle when you're trying to find the third number here. Once you have all three of these numbers, they're always going to check out with each other. The rate, the income, and the value, every one of these formulas is always going to be true once you've found all three of these numbers. And they really all go hand in hand together. Now, we're going to talk about what type of income it is that we're going to be using here, because it's very important that you look the right kind of income. Otherwise, your capitalization rate is just going to be completely incorrect. So we're going to go over that. But first, I want to give a quick shout out to Mark Vansco tuning in on YouTube, asking what section in the book is this. So this is in the appraisal chapter. If any of you guys took the pre-licensing course in the classroom, I think it's unit 16 that's in there. On the online course, it's like level, I think, 5 or 6 that you'll see the chat section on appraisal. So it's a big part of your real estate exams if you are practicing this for your exams. That's an 8% chapter. 8% of your questions on your exam are coming from the appraisal chapter, which this is definitely something where you're very likely to see math on it. But again, you've got to make sure that we're dealing with the right kind of income. So we're going to deal with that after this quick commercial break. I'm John Carissimo. You're watching Ask the Instructor.
Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com.
Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Chrismo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Chrismo, and this show is brought to you by the Tampa School of Real Estate every Wednesday at 12 noon Eastern Time. If you're not subscribed yet, go ahead and hit the subscribe button so you don't miss any of these shows, because we do this every week at 12 noon Eastern Time for our current, our past, as well as our future students. And don't worry if you haven't signed up for a course with us yet, you could still tune in to any of these live streams that we have on YouTube, on Facebook, or as well as our Success Center, tampaschool.com/success. If you're enjoying today's episode and you want to watch the whole episode in full, or you want to check out some of the other episodes of Ask the Instructor or State of Real Estate, they're all available on our Success Center. Again, that link is tampaschool.com/success. So make sure you go on there after the show and check out the rerun of this episode or whatever episodes it is that you want to go in and learn more about real estate. We also have State of Real Estate on there, which is a great show that we do on Fridays to help you grow your real estate business. So definitely check that out. Again, that's tampaschool.com/success. So today we're talking about capitalization rate, or cap rate, as you hear the term thrown around. Just like you hear that word comp thrown around all the time, you'll hear cap rate depending on the type of people it is that you're talking to. And we went through this Irv Triangle, and this is ultimately how you find that capitalization rate. This is the formula right here. Rate is the income of the property divided by the value. But it's a very specific type of income that we're using, because cap rate, what's great about it and why you hear it used so much as a term when we're talking about investment real estate is because it's very standardized for the method you use to determine the capitalization rate. And this is something that investors are going to look at when they're purchasing property, that lenders are going to look at when they're financing investment property, that anytime you're dealing with investment real estate where there's income producing property, the capitalization rate is important, whether that's residential, commercial, office space, industrial space, agricultural property. Anytime when we have income producing property, the cap rate. And you could even apply this concept to even a business or anything really that does generate income. But now the reason why I erased everything up top here is because we need to filter down to the correct type of income. And this is the Irv Triangle, but the Irv Triangle, I like to think of this as just the bottom part of our income capitalization hourglass. So we've got the hourglass here. And the reason why I like to draw this as an hourglass, if you imagine an hourglass, you've got the sand up here and it's trickling down. And what's going on with the top part of this, in this diagram at least, is we have three different levels of income. And not only is it important to understand and know the terms of these different types of income, whether this is for your exam or for the real world when you're dealing with investment property, it's important to know what those numbers mean, what these words mean. So number one, you've got to know what they're called, and number two, you have to know what it means. And we're going to start out up at the top here, and you can kind of think of this almost like a funnel, and what we're doing is funneling down to the right kind of income. And once we have that right kind of income, now we could find the capitalization rate based against the value of the property to say, okay, if we pay this much for the property and we get this much net operating income, which is what we're going to be looking for with these three types of income up here, that's going to give us this capitalization rate, which gives us this return on our investment in 1 year, assuming that we pay 100% cash for the property. And again, even if this property is being financed, this is still an important calculation to know. So we've got our three levels of income. We're going to start out up top with what's called PGI. So PGI stands for potential gross income. And again, it is important to understand what each one of these letters stands for. It's potential gross income. So potential gross income, if we think of those words, and this helps you remember what we're talking about when we say potential gross income, So let's start off first with the word we're probably most familiar with here, income, money coming in. So we're talking about money coming in. Gross income, so that modifier, that prefix of gross, this is standard across accounting, and it means before any expenses have been taken out. So we know that we're dealing with income before expenses. But we have another modifier to this type of income. It's not just gross income, it's potential gross income. And potential gross income tells us what's the potential of this property. So maybe there's 4 units on a property, or maybe it's a 10-unit property. We're assuming with potential gross income that every one of those units is going to be rented 100% of the time. And not only are they going to be rented 100% of the time, but we're not going to have any collection losses. It means everyone pays on time and we don't have to go evict anybody out of there, and we're not having the property sitting vacant, which is a little bit of a fantasy, but this does tell you basically the most amount of income that the property is able to generate. In a perfect world, if you have a perfect year where you're rocking at 100% occupancy with no collection losses or anything like that, that would be your potential gross income. That would be what you actually have coming in for the property. But it's not a perfect world. You're not going to be rented 100% of the time with 100% occupancy with all the tenants paying rent all the time. You know, you might get lucky if that does happen, but that's not the case. So we have something called vacancy and collection losses. And that's what we're going to subtract from this potential gross income. I like to draw this in right here on the side of this here. We've got our vacancy and collection losses. So we're subtracting that out right here. And by subtracting out our vacancy and collection losses from this potential gross income, we're basically going from here, subtracting out vacancy and collection losses, and then we're going to have our next level of income. And once we've subtracted the vacancy and collection losses, we have a little bit better idea of the actual money that's going to be coming in. But we don't call it actual money coming in, we call it effective gross income. So that's our second level of income here. It's called EGI. That's the acronym for this, EGI. And that stands for, just like we had before, gross income, but the only difference is that this is effective gross income. And this is once we've subtracted those vacancy and collection losses. Now, depending on when and why it is that we're working with the income and trying to find the capitalization rate on the property, we might use actual vacancy and collection losses across the last year of the property to find out, okay, what is our cap rate on the property for this year? Or we could also use this for a vacant property or a property that has not been rented or has yet to be built. And what we do is we find a pro forma or a kind of standard average vacancy and collection loss for the particular market it is that you're in. And depending on the market, that number may be lower, that number may be higher. It's typically given as a percentage. So let's say that the vacancy and collection losses are 10%. That means we're losing 10% of our potential gross income before we get to the actual money coming in. That means 10% of the time we have property sitting vacant or we're having collection losses. That attributes to 10% of the potential of the property, or whatever that number may be. It may be 5%, maybe 7%, maybe 15%. Again, it depends on the specific property, depends on the market, and again, if you're going to see something like this on your exam, it's going to give it to you in the question somehow, some way of telling you these are the vacancy and collection losses of the property. Now, what's important is you have to know when it is that you're taking these out. If you've already got the effective gross income, that means the vacancy and collection losses have already been taken out, because that's how you descend down from potential gross income to effective gross income, is you subtract the vacancy and collection losses. So the money you lost from the property sitting vacant or not collecting rent for the property. So if you've already been given effective gross income, you don't need to backtrack up to potential gross income. You've already got the effective gross income, so no need to worry about vacancy and collection losses. And that's important for your exam as well, because they may tell you this is the effective gross income, but at the same time also tell you that there's 10% vacancy and collection losses. All they're doing when they're mentioning the vacancy and collection losses, if they've already told you effective gross income, is just giving you extra information that you're not going to need to get down to our next level of income. So moving down into our next level of income, we're going to have what's called NOI. NOI, which stands for net operating income. And that's the type of income that we're ultimately looking for in this IRV triangle, which is why this kind of flows right into that there, as you can see. So this is a really good memory tool to help you remember these different levels of income, how it is that they're laid out and whatnot. You don't need to remember it this way, but it is extremely helpful when you could visualize something like this in your head or drawing something like this out to make sure that you're dealing with the right kind of income. So with net operating income, this is our income after we've subtracted one other thing. And if we break down the word here, the phrase of net operating income, completely different from potential gross income and effective gross income. The only thing we're still dealing with here is income. But it's no longer gross income, it's now net income. N-E-T, net income. And net income is another term that you'll see across accounting ecosystems, accounting systems, and it's a term that always means after expenses. Gross means before expenses, net means after expenses. And if you want a little way to remember that term gross, if you don't like accounting, I understand that. The way to remember gross is, let's say you're the landlord of this property. You're going to see these numbers up here, and you're going to think that's gross because you see, oh, these are all the money I'm losing to expenses. So that's my little way you can kind of remember gross means before expenses. Think of you as the landlord. Oh, that's a gross number. I don't want to see that number. I want to see the number after expenses because that's the money I'm actually walking away with from the property. So we're subtracting out now to get down to this, our operating expenses. So just like we subtracted the vacancy and collection losses to get down to EGI, we're going to subtract out now our operating expenses. And that's going to take us from our gross income down now to our net operating income. Now, another way you could remember this is when you're looking at net operating income, you could remember not operating expenses. Net means not expenses, and not what type of expenses, it tells you right in the name, and that's the importance of remembering the phrases here. So net operating income is not operating expenses, or not including operating expenses, because we've taken those out. And the operating expenses, to give you an idea of what you may see for something like that, these are all of the expenses that we have to operate the property. It does not include any sort of debt servicing or financing or anything along those lines. Anything that's financing related, you don't include in here. Remember, the assumption that we have when we're working with the income capitalization approach and we're dealing with cap rates is that we're assuming we're going 100% cash. Now, that doesn't necessarily have to be true. You could be buying the property and still look at cap rate, but be using financing. It's okay to do that, but you have to understand that this whole, in order to make this standardized, in order to make this mean the same thing to all investors, it has to be when we're not assuming financing. Because if we have financing involved here, if that was an operating expense, a cap rate for one investor might be a different cap rate for another investor. So in order to make cap rate so standard, as well as all these levels of income and the value it is that you're coming up with the property, you need to always remember that we're not dealing with any financing, but things that are included under operating expenses. Utility costs that are paid for not specifically by a tenant. So maybe the tenant pays for their own utility costs, but maybe there's some utility costs for common areas. Maybe for the sprinkler system, there's a little bit of a water bill for that. Maybe there's some sort of street lights in the parking lot, or anything like that that costs money to operate. The garbage collection, if that's not billed directly to the tenant, then that could be another operating expense. The landscaping is another operating expense. We also have what's called reserve for replacements. And reserves for replacements is money that's set aside every month, every year, so that way we have this reserve account, this money that's set aside, this cash that's set aside. So for things like if an air conditioning unit breaks, the cash is already set aside to replace that air conditioning unit. If a range breaks, we've already got the money set aside to replace the range. So that's called reserve for replacements. You might have those for the roofs as well. Those are things that have to be replaced every 25, 30 years, maybe 20 years, depending on the condition, the construction, and so on and so forth. So those reserves for replacements, you want to look for, and this is just the way to kind of categorize properties on the surface level. When you're trying to analyze investments on a much more in-depth level, you want to look at, okay, what are the reserves? When was the last time the roof has been replaced? What's the average age of the air conditioning units? And let's say we're looking at an apartment complex with 500 units. What's the average age of the air conditioning units? Are we looking at having to replace all these AC units in the next 5 to 10 years? So these are all things that you want to look at when you're looking at this more at the micro level and trying to analyze these little details of the property. When you're looking at the macro level, when you're looking overall at the entire property and just trying to determine if this is even worth your time to look at some of these minor details, this is where this becomes very helpful. So reserves for replacements, that's another operating expense because it's money that's set aside. Now that operating expense isn't a tax-deductible operating expense. The IRS unfortunately doesn't allow you to deduct expenses that haven't been spent. They have to actually have been spent for them to be tax deductible, but you do have the reserves for replacements that are included here. So it gets a little bit confusing when you start getting into the taxes there because you won't include those reserves, but you would include them on this. But what you would also include are the expenses that you have to replace said air conditioning unit, or maybe you're repainting the plaza or the apartment complex or whatever type of investment property it is that we're dealing with here. If that's being repainted, that's going to be another operating expense. Any of these things that cost for repairs, normal wear and tear type of stuff, any money that's spent that's not related to financing is pretty much included as an operating expense. And once we have our effective gross income, which is our income once we've taken out our vacancy and collection losses, the money that's effectively coming in, we've got our effective gross income, so we could expect, okay, this is the amount of cash that we have coming in, but now we subtract out our operating expenses, and those operating expenses will give us our net operating income, which tell us, okay, after expenses, this is how much cash we could see coming out of this property. Now remember, financing expenses aren't included here, so if you're an investor or working with an investor that's using financing, you would take that net operating income, the money coming out of the property, and use that to determine as to whether or not you're going to be able to service the debt, as to whether or not you're able to pay the financing expenses for all of this here. But other than that, that's our 3 levels of income. Now, once we have these 3 levels of income and really just the net operating income, this is the right kind of income, the income it is that we're looking for, the NOI. That's what we use for the IRV triangle, and that's kind of how this drops down here. We need to have the net operating income in order to find the capitalization rate. We don't ever base capitalization rate on any other type of income except for net operating income. And that's why, again, this is such a standardized method, which makes it easy to categorize investments. So we're going to actually work through some examples of this, work through some numbers. I want to go through and give you a couple scenarios where we're actually working with a specific property and understanding the cap rate of a particular property with some expenses and everything like that factored in. But first, we're going to take a quick commercial break, so stick with us. I'm John Carissimo. You're watching Ask the Instructor.
Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com.
Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Chrismo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Chrismo, and this show is brought to you by the Tampa School of Real Estate. Every Wednesday, 12 noon Eastern Time, we come to you live, to our current students, to our past students, to our future students, to help you get a better understanding of the technical side of the real estate industry. Now, this is absolutely something it is that you learn in the pre-licensing course, so maybe you're tuning in here to just get a little bit of a refresher on this, so you make sure you can answer these questions right on your exam. You're guaranteed to see this question at least once on your class and state exams. This is a very popular topic that is questioned on quite a bit. It's out of a large chapter in your course, and the reason why they do ask that on the exam, not just because it's an in-depth math problem, it'll really put you through the paces for testing out your math skills, but also this is something that's very practical and very real world, something that you do see in basically any sort of investment property scenario, at least any investment property that produces income. That's where you want to understand the capitalization rate. And you might see this figured out in different methods, but this is the standardized method to calculate cap rate and understand what the return on investment would be on a property based on the cash coming out of it on the first year. So we're going to go through and work through an example of this here. And what we're going to do is we're going to start all the way from the beginning. So we're going to assume that this scenario is that we're a listing agent and we're marketing a quadplex for sale. So we've got a quadplex property, so 4 units. And currently that quadplex is vacant. It doesn't have any tenants in it. But we look at that as the real estate professional is that we are, and the seller of the property has asked us to list the property. Now, anytime it is that you're listing an income-producing property or any sort of investment property, you're going to want to publish a cap rate for the property. You're going to want to publish a net operating income, an effective gross income, a potential gross income, even if the property is vacant. Because a potential investor, they might be too lazy to do their own math. Or maybe the math it is that they're doing isn't perfect or correct or the most accurate. So you want to put this information out there in your listing about this property, about the capitalization rate, about the estimated value of the property, about the potential gross income the property could generate, as well as the net operating income, assuming expenses, even if you don't have any of that data. So real estate is very localized in its nature. Real estate is not the same all over the world. Now it's similar. Cap rate can be used all over the world, but the expenses are going to vary based on the market. The vacancy and collection losses are going to vary based on the market. And we're talking not even just about an entire city, but even down to little pockets in the city might have different vacancy rates than other pockets of the city. So real estate is so localized. That's why, even in the investment world, the investors will rely on knowledgeable brokers and sales associates to convey the necessary information. Now, it's still up to them to do their due diligence, but you're there to aid in their due diligence, to make it a little bit easy. Remember, capitalization rate is just designed to help categorize really the property based on its return on investment. Even if this is just an estimated return on investment, you'll still get more in detail and look at the individual factors and individual parts of the property, but this initial estimation of what the capitalization rate is, what the income would be, and what the value would be of the property is going to help point people in the right direction and see if this is even something that they should spend their time working on. So let's go back to this 4-unit property that we're listing. Let's say that this 4-unit property, we're looking at the market and we're saying, okay, based on the other similar properties in the market, we could rent this out for maybe about $1,000 a unit a month. So $1,000 per unit per month. So that's how we talk about rent. When we talk about rent, at least for residential property, commercial property usually gets a little bit different for the common way that rent is referred to. But with residential property, we're usually referring to rent, and that's how consumers see rent is, okay, this is how much it costs per month to live in this property. So we've got 4 units here that each rent out for $1,000 a month. And rent, you always assume that it's monthly. But when we're dealing with income, we don't want a monthly number. So we know that this is $4,000 per month, but that's not our potential gross income. Our potential gross income is always, anytime you're dealing with income, we're always assuming that we're talking about an annual number. Because the landlords, the investors, they're looking at the overall year of how much money it is that they're going to return across a year. The tenants are thinking about this per month. The landlord's thinking about this, okay, across the entire year, how much money it is that we have coming in. A tenant will sign a lease based on a monthly rate, a monthly rent for the property. The landlord's looking at that and saying, okay, that's going to generate me $48,000, or each one of these units here would be $12,000 it would be generating over the course of a year. So our potential gross income here is annual. So that would be $4,000 because we've got 4 units, each renting at $1,000 a month. And we multiply that by 12, 4,000 times 12, and we get a potential gross income of $48,000. So our potential gross income is $48,000. And you might say, John, but what if one of the units don't rent out? What if somebody isn't paying their rent on time? Is it still $48,000? Yes. The reason why is because that's potential gross income. Now, when we talk about effective gross income, our next level of income, then we're going to take out those vacancy and collection losses. We're going to subtract out those vacancies and collection losses that we receive on a property, which is completely normal. Every property has vacancy and collection losses. And typically that's going to be given as some sort of percentage. And let's say that this percentage is 10%. So 10% of the time, the property is going to be considered vacant or having collection losses, or 10% of this $48,000 we're going to lose due to vacancy and collection losses. So what we're going to be doing basically is taking 10% of the potential gross income, we're subtracting that out, and that's going to give us our effective gross income. So 10% of $48,000 would be $4,800, $4,800. So we subtract out $4,800, and remember that's our vacancy and collection. Once we've subtracted out that $4,800, now we're going to have our effective gross income. And if my math's right, we should end up with $43,200. So our effective gross income on the property, how much we effectively have coming in, is $43,200. Now let's back up a little bit and go over again what we just did here and back to our scenario of we're the listing agent for this property. So we're the listing agent for this property. We look at this vacant property and we say, okay, each unit could rent out for $1,000 a month. For a year, that gives us a potential gross income of $48,000. But just as you should know, as every other landlord is going to know, every other investor that wants to buy this property, they're going to know that not every unit is going to be rented 100% of the time. So what you want to do is look at the market, look at the individual market it is that you're dealing with, and try to get an understanding of what these vacancy and collection losses actually are. You could look at other properties available for sale. You could contact other landlords. Maybe you're managing some properties that maybe you do property management for too, and you have an understanding of in this market, this is what the vacancy and collection losses are. But you want to use a number that's based on the market. Now, if you do see this on your exam, that number is going to be given to you in some way or another, so you won't have to do the interpretation aspect of this, but in the real world, you're interpreting what that vacancy and collection loss number may be. So once we've taken out those vacancy and collection losses, now we have our effective gross income. So we could expect on this 4-unit property to have $43,200 actually coming in. But that's not the income that we're concerned with as an investor. Remember, the investors, the landlords, they're going to look at this number, and once they see the net income, they're going to think this number is gross, because this is how much more money they could be having if we didn't have expenses. And no one likes expenses, but they're a cost of doing business. So in order to get down to our net operating income, again, we're estimating what the vacancy and collection losses are, and we're also going to estimate what our operating expenses are. And let's say that we're estimating it's going to be $20,000 to operate this property, for various operating expenses, for utility costs. Some of these expenses you might already have with the property, even though it may be vacant, and then other expenses are going to be ones you have to kind of predict here. So again, the interpretation of this in the real world gets a little bit more nitty-gritty. You want to look at what expenses are there. Even if the property is vacant, there's got to be some sort of expenses. Property taxes are going to be there whether the property is occupied or vacant. So you're always going to have property taxes. That's usually one of your biggest operating expenses. But then on top of that, whatever utility cost you have, whatever money that's being set aside for reserves, these are all things that should already be there as an operating expense. So you want to go through all the expenses, anything that's not related to financing, that's related to the operation of the property, that's an operating expense, and you're going to subtract it out. Again, on your exam, they're going to give you some sort of number. And let's say after our calculations, or what it says on the exam, if this is an exam question, is that our operating expenses are $20,000. So again, we're subtracting this out, and that's going to take us from our effective gross income down to our net operating income. So we subtract out the $20,000 from this $43,200, and that's our expenses. So minus $20,000. And now finally, we're going to have the right kind of income, the income that we're looking for as an investor, just to understand, okay, what's our cash flow going to be out of this property without factoring in any sort of financing. And once we subtracted out that $20,000, we end up with $23,200. So $23,200 is our NOI, our net operating income. And that's the type of income it is that we want to look at as an investor, the net operating income. Because again, that tells us how much cash is coming out of this particular property. But now let's go over the interpretation of some of these numbers as well, because not only do you want to advertise a capitalization rate, you also want to be able to advertise these numbers, especially if you're using estimations for these numbers, or a better term for an estimation, making it up. That's really what's happening. So it's very important that you're clear about the numbers it is that you've made up, that you've estimated for this property, and include basically this whole breakdown here. Potential gross income of $48,000 based on each unit renting for $1,000 a month. Vacancy and collection losses at 10%, estimated at $4,800, giving us an effective gross income of $43,200, with estimated expenses of $20,000, giving us an estimated net operating income of $23,200. And notice how I use that word estimation, just so we're clear that, hey, these are estimates for this property. You should do your own due diligence to double check this. And now, as an investor, for interpreting this here, what you want to look at, especially when you have these numbers all ending in zeros and whatnot, you want to maybe play with these numbers a little bit and get a feel for, okay, what if the income's a little bit higher? What if the income's a little bit lower? What if the vacancy and collection losses end up being higher? What if the expenses end up being higher? What if the expenses are lower? Again, and kind of looking at all of this here. Now, depending on the way the property is managed, if it's being mismanaged, this number might be a lot higher than it should be. So that's where you start looking at the nitty-gritties of this here, and you start to understand, okay, we've got really high expenses for this property here. What's going on? Why are the expenses so high? What kind of mismanagement do we have? What kind of staff do we have? What kind of property management company is at this property that's maybe taking too big of a cut, that's getting too much money off of this? So you also go through and interpret these numbers directly as well. But again, this is all stuff that you'll see if you start looking up investment properties. You should be able to see if it's a good listing, all of this data, especially if it is occupied. If it is occupied, these numbers become more valid. They become more relevant. The estimation, definitely do your due diligence with this, and especially when you see these numbers ending in zeros, that's a red flag. If it doesn't say it's an estimation, it's probably an estimation. So we're going to go work through now the Irv Triangle and actually figure out the capitalization rate for this particular property and figure out what the value is for this particular property. But first, we're going to take a quick commercial break, so stick with us. I'm John Crismo. You're watching Ask the Instructor.
Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com.
Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Chrismo. You're watching Ask the Instructor. Hey, welcome back to this week's episode of Ask the Instructor. I'm John Chrismo, and this show is brought to you by the Tampa School of Real Estate. Every Wednesday at 12 noon Eastern Time, we come to you live to help you understand the technical side of the real estate industry. If this stuff is getting you excited and you don't have your real estate license yet, you should get your real estate license, because if you like this math, if you like working with these numbers here, there's people that need your help, that need help buying a property, even not involving these numbers here. Maybe you don't like these numbers whatsoever. It's okay. Residential consumers, they're not concerned with the capitalization rate of a property. They just want to buy a property that's got a good floor plan, that's in a good school district, and all that type of stuff. But if you do like these numbers, there's a lot of commercial opportunities out there for rental properties like we're dealing with here, or this could very easily be a shopping plaza with 4 units in the shopping plaza as well. And even though these investors are professionals at purchasing property, they still involve brokerage companies because there's a lot to be done. And the big investors are good at outsourcing this work to a broker it is that they trust. So there's plenty of opportunities out there, and if you want to get your real estate license, or at least find out how, make sure you go to tampaschool.com. There's a big button right on the front page that says how to get licensed, and you can see the steps it takes to get a real estate license in Florida, which isn't that much, especially compared to some of the stuff you have to go through in some other states to get a real estate license. And if any of that stuff confuses you, just give us a call at any point, whether you have your license or you don't have your license, for continuing education, post-licensing, or whatever questions it is that you have for us. The phone number is right below. It's 813-928-0106. Again, that's 813-928-0106. They're standing by to answer any questions you have and assist you in any way it is that they can. But let's get back into the income capitalization approach here. And we figured out now the income of the property. So we've gone this far, but we still need to figure out these other numbers here. Now, you need 2 of these numbers in order to find the third. We've got one number here, the income, but now we have to determine, in order to find the value, that we're going to list the property. And this is found in the appraisal section in your pre-licensing course, because that's essentially what you're doing with this income capitalization approach. You're using the income to find the value of the property. And it's all based on the capitalization rate or the return on investment it is that you want to achieve. So this rate or return on investment, whatever it is that you want to call it, if we're trying to find the value, we need to estimate a rate of return, or use a market rate of return in order to find the estimated value of the property. So maybe if we look at the market for these similar properties we've been looking at, the same way we came up with the 10% vacancy and collection losses, the same way we came up with the operating expenses, and just like in the real world you're interpreting this on the exam, this number would be given to you, but we need some sort of rate of return. So let's assume that we're dealing with a 10% rate of return, or a 10% cap rate. So again, our formula now, we're actually looking for value. We're trying to find the value of the property. We're saying, okay, we're listing this property for sale. We've estimated the income. We're saying, okay, in this market, investors are looking for a 10% return on investment. We need to have a 10% cap rate to be competitive with the other properties available for sale. So at a 10% cap rate, this would be our value. So in order to find that, remember, we circle what we're looking for. We're looking for value. What's left over is income over rate. So value is income divided by the rate. We've got our income. Remember, the income that we're dealing with is the net operating income. That's why this funnels down, hourglass is down, whatever it is that you want to call this here, to this Irv Triangle. So we're going to take our income of $23,200, And we're going to divide that by our rate of return. And again, we're saying, okay, we need 10%. We need a 10% rate of return in order to be competitive with the market. So we're going to divide that by 10%. Which you can punch that right in your calculator as 0.10, or if you like the percent key on your calculator, you can work with that as well. But either way, you're going to find that the value of the property is going to end up being $232,000. So if we have an investor that pays $232,000 for this property, they're going to generate, by our estimations, $23,200 in net operating income, which will give them a 10% return on investment. And that's how these numbers all come together and all kind of check out with each other. So once we have all this, now we've got the information we could advertise, the 10% cap rate, the price of $232,000, the income of $23,200. But let's say we were trying to find that capitalization rate. Let's say, and we're going to use some different numbers for this one here so you can kind of see how this would all come together. Let's say that we're looking at buying this property and we want to make an offer on the property. And we're not so keen on paying $232,000 for this particular property. Maybe we're thinking of paying $200,000 for this property. So now you can see how this is on the other side of this as well. This could be on the side of this of you advising the seller of this property. It could also be you advising the buyer of this property using this income capitalization approach. So let's say that the buyer asks us, what would be the capitalization rate if we pay $200,000 for this property? Okay, now we can do the math on that. So what we're trying to find at this question, what is the capitalization rate if our value is $200,000? Our income staying the same, but now our value changing. So we're going to use that formula for rate. Capitalization rate equals, remember we circle what we're looking for. We're looking for the rate. We're left with income over value. So what would be the rate of return with our same income, our same $23,200 of income, but now our value is going to be $200,000. Because again, we're looking at offering $200,000 for this property and we want to find out what our rate of return would be. So we're just going to get our nice little calculator out. We've got our formula nice and easy here. We're just going to take $23,200 and then divide that by $200,000. And we end up with 0.116, meaning 11.6%. So our rate of return, if we were to pay $200,000 for this property, would be 11.6%. And now, this investor sees this and they're like, okay, yeah, 11.6%, that I like a lot better than just 10%. I like being able to pay this amount for it and I like 11.6%. But now let's say that we go back to we make that offer to our seller and the seller says, no, I'm not taking a penny less than $232,000. 10% is a good rate. If they want to buy the property, I'm firm on the $232,000. So, okay, we're at another impasse here. But now we could go back to the Irv Triangle, go back to the Irv Triangle and say, okay, well, we want the 11.6 return on investment. Hey, let's bump it up. Let's say 12% return on investment. What do we have to do? What does our income have to rise to if we want to get a 12% cap rate on this property and still pay $232,000? And that brings us to our third calculation. What would be our net operating income? So we'll do that one up here, running out of space. Our income is rate times the value. So what income do we need if we want a 12% rate of return, because we're trying to maximize the rate of return, but still pay the seller the $232,000 that they're looking for on this property? So we're going to take our rate. We're looking for a 12% rate, which is 0.12 if we're going to put that in our calculator. And we're going to multiply that now by the value that the seller wants, the price that the seller wants of $232,000. And we multiply the two of those together, and that's going to tell us the income it is that we need to bump this up to. that it can't just be $23,200 if we want our 12% rate of return. Or maybe we're looking at this for down the road. We're saying, yeah, 10% is nice. We'll get into this property at 10%, but now how do we juice up our income on the property? How much do we need to increase our income on this property to bump ourselves up to a 12% rate of return? So we're going to take 12%, 0.12, we're going to put that on our calculator, and multiply that by $232,000, and we end up with $27,840. So $27,840. If we could get our net operating income up to $27,840, then we're at 12% return on investment, which that's an opportunity there. If maybe you're going in here, you're operating the property for a while, and you're able to increase that capitalization rate to 12%, you can now resell this property for a higher price because you've now got the property generating more income, and you could still market it at that same 10% cap rate. And now let's look at how the value has changed on this if we're doing this based on $27,840. So let's say we're still going to take it to market. We're reselling this property now. We're going to take it to market with a 10% cap rate, but now we're basing it on $27,840 of income. Divide that by the 10% capitalization rate, and now we've increased the property from the $232,000 up to $278,400. So that's how you're able to increase the property value. And now, because with somebody that's looking to buy and hold a property for rental income, they're usually not looking to hold it indefinitely, forever and ever. They're purchasing the property, and then they're planning on reselling it at some point when the timing's right. But along the way, they're earning cash flow off of the property. And you might say, well, how possible is that to increase our net operating income from $23,200 to $27,840? It's very possible. Let's see how much we have to decrease our operating expenses in order to make that happen. And all we're doing here, so let's find the difference with this here. We've got $27,840. We're going to subtract that from our previous net operating income of $23,200. We end up with $4,600, just a little over $4,600, $4,640. That we need to shave off of our operating expenses. So if we cut our operating expenses down to just under $16,000 instead of $20,000, remember, there's opportunity here. Maybe this is a mismanaged property, and it would be very easy to cut off $5,000, to shave off $5,000 off of this property, if off the operating expenses. If you're able to do that, you can now remarket, resell the property, still with a 10% capitalization rate. And now if you paid $232,000 on it, and you get that up to $278,000 that you're able to sell that for, advertising this at the same capitalization rate that you went at. So $278,000 minus $232,000, that's a $46,000 profit on top of any money it is that you've collected in cash flow coming out of the property. So that's huge there. And again, there's tons of opportunities like this out there in commercial real estate, in apartment complexes, in retail plazas, and office buildings. And there's a lot of different ways to influence this. We could lower the vacancy and collection losses. We could increase the rents. We could lower our operating expenses. And all these things affect the income. The more it is you're able to pump up and juice up that income, the higher it is that you're able to sell the property for if you're keeping that same rate of return. So that's capitalization rate and the income capitalization approach to estimating value of a property. Now again, this isn't something you would use for residential consumers, so most real estate transactions, you'll never be involved with this type of math. But if you're dealing with investors, this is essential. This is essential to understand. This is the basic understanding to know this formula inside and out, what these numbers mean, how to manipulate them, how to increase the value. If you don't know that, the investor is not going to see value in you. They're trying to see the value in the property, and you show value by showing where that value could be gained in the property, where that value could be lost in the property. So you've got to know this if you ever plan on working with an investor on income-producing property. And this is, again, something, if you're just looking to get your real estate license, that you do want to know for your exam. Maybe not as in-depth as we got to this tail end where we're manipulating this, trying to get the income higher and going off all that, but you do want to know these basic calculations for your exam, very likely to show up on there. That's all I've got for you guys today. Thank you for tuning in. Remember, if you want to watch the whole rerun of this episode, as well as any of the other episodes of Ask the Instructor or State of Real Estate, you can find those all on our Success Center. That's tampaschool.com/success. Again, tampaschool.com/success. Best thing for you to do is drop your email in there, and we're going to notify you anytime it is that we go live. So that way you could live chat your questions with us. If there's anything here that you didn't understand, you'll be able to ask those questions in real time while we're live on the air. So definitely check that out. Remember, if you're looking to get your real estate license or you have post-licensing to complete or maybe continue your education or anything like that, go to our website, tampaschool.com. You'll find all the resources it is that you need on there, including our Pass First Try strategy. And that's something I highly recommend to anyone looking to get their real estate license. You can take your exams again and again and again and again and again, but that's going to cost you time, money, and frustration. You don't want that mental stress in there. So by preparing in advance to these exams, you could set yourself up to pass the exams on the first try. These exams are passable if you're confident in your knowledge of the information. And our Pass First Try strategy is designed to make you confident in your knowledge of this information. That's all available at passfirsttry.com. It's a recommended strategy to help you pass your class and state exams on the first try. So absolutely check that out. If you have questions for any of this stuff that you want to ask us, one of our advisors, again, give us a call. The phone number is 813-928-0106. Thank you guys for tuning in, and I'll see you Friday for State of Real Estate.
Do you want to incorporate studying for your real estate exams into your busy schedule? Now you can review the key topics you need to know to pass your class and state exams with our MP3 audio review. Simply pop in your headphones or connect to your car to reinforce crucial information while you exercise or drive. Listen to the first unit for free at mp3audioreview.com. That's mp3audioreview.com. Does your current career allow for unlimited income potential? With a career in real estate, the sky is the limit. What you put in is what you get out. Find out more about how you can tap into the unlimited income potential of a career in real estate at tampaschool.com.
Hey, if you're enjoying the show today, which I'm sure you are, be sure to hit like, subscribe, post your comments, share with your friends and family. Thank you guys so much for watching.
You are watching
Ask the Instructor. Every Wednesday at 12 noon Eastern Time. I'm John Chrismo. You're watching Ask the Instructor.